In a world where two short-term rental bros come together.
What?
Not in that way, bro. There's a podcast of truly epic proportions where we talk about all things short-term rental and shoot the shit along the way. Welcome to the Co-Host Bros Podcast. Here are your hosts, Matt Codd and Austin Spitz.
Hey everybody, welcome to another episode of Co-Host Bros. My name is Matt and I'm here with my buddy Austin, and we got a special guest today. We got Parker Borofsky. Did I say it right that time?
Close enough.
She is close. It's hard to hit. She's with the Wealth Builders Mortgage Group, and she's going to help you learn how to get a loan for your next short-term rental. So welcome, Parker.
Thank you. Also, does this mean, am I an honorary bro today?
I'll bring you a hat next time I see you.
All
I'll
right.
have some extra.
I like it.
Actually, I have some coming in the mail. Austin won't wear my hats, so
What?
I don't know.
I haven't
His
gotten
head's
one.
too
I haven't.
big.
It must have got lost in the mail. I haven't gotten one yet, so I don't know.
Because you moved. You moved away from me. That's why.
Oh, it's at my
Now you
old
gotta
house.
drive
It's
for
at
it.
my old address. Yeah. So whoever's living
Yeah.
there is wearing a co-host bros hat for us. So somebody's representing out there somewhere.
Nice.
Yeah, at least somebody's doing it. So, what's going on with you, Parker? You got anything new coming with you?
No, same old, just financing for people and, hanging on with our own rentals, which is always an adventure every day, right? So
Yeah. So you have a set of cabins, right?
we have 12
Which
total.
cabins?
Mm-hmm.
12.
Yep.
Okay.
Yeah.
So when I talked to your husband Oz, he said you guys were building another one.
We
Or
are,
adding
yeah.
one, or
Well, one of the 12 is one we found out recently. We're just gonna have to knock down what's existing and rebuild. So that's always fun. Yeah.
So
is
what
there a loan
market
for that?
Mhm.
I'm just kidding.
What's that, Austin?
I was going to say, what market are you primarily invested in?
So we've got 7 existing, and then the one we're building in the Smokies. And then we've got 4 in the Panhandle of Florida. So between Santa Rosa Beach on 30A and Pensacola.
So we know you're a beast on the lending side of things, and we'll get into that. But my question is, how does that look for your business from a management perspective? Do you self-manage as well, have all the systems and processes in place, or are you hiring that service out?
Great question. So my husband and I have always self-managed and are still self-managing, which is fun. And yes, it's hard. I have a hard time letting go. He handles most of the issues, problems. I've got him handling the cleaners. I'll handle like the messages, the incoming messages. And then from a system standpoint, I feel like, so we just recently switched to Owner Res. We were on Guesty for hosts. And I do feel it's more robust. It was a few months in the making to switch. That was a beast to get everything transferred over.
So what features did you specifically like about Owner Res versus Guesty? Because full transparency, I manage 8 properties and I haven't found a need to change my PMS structure. And Matt and I both simply only use Hospitable, and I haven't found a need for Owner Res. But is there some features that maybe I'm perhaps missing out as a host that they provide that you like?
For us, and I think Hospitable does this as well, but I don't believe Guesty did. So my initial switch was because Verbo told everybody, hey, you're going to have to process your own payments, even if it was on Guesty. And so I didn't feel like Guesty had a robust enough system to handle payment collection. So that was initially what triggered it. And I do feel like Owner Res has a pretty good system for that. However, so we are using Hospitable for messaging because I think Owner Res is lacking there a little bit. Now, although when I talked to the Hospitable people at a conference recently, what I did like about Hospitable is they said that they handle payments. You don't have to do your own payment processing, even for your own website that you build with them. And so that made me consider maybe we need to switch to hospitable. I'm not there yet. We'll give owner-res a good run. So far, it's been fine. But yeah, I don't know. And when it comes to owner-res versus hospitable, I don't know that you are missing anything. I get a lot of feedback on reporting. So I guess it just depends on what reports you run and if you're getting what you need. But yeah.
Yeah, they're a little different. But yeah, hospitable runs the merchant of record, but the reporting for owner-res is, second to none. Hospitable did introduce some reporting. It's lackluster, but their messaging is fantastic. And I know setting up owner-res is complex. I know you said it took you a long time. So yeah, you can set up hospitable in like 30 minutes. It's kind of like the difference between whether you use an iPhone or Android type deal. So
yeah,
but yeah. So what's the newest loan product that short-term rental people should know about, or investors, I should say?
I don't know that there's a new one per se, but there is one that I feel is underutilized. And that's the conventional investment occupancy. So a lot of times what I find when clients come to me or prospects come to me is they're thinking either the second home loan, that 10% down, or DSCR, from one extreme to the other. And a lot of people, I feel, forget about, or at least when I introduce them to this, they seem surprised. And that's the investment occupancy conventional loan. It's we'll call it the cousin to the second home loan. And it's 15% down, but we can also use projected rental income. So it's kind of a hybrid between the DSCR and the second home loan. The benefit is it allows you a little bit lower down payment and typically has slightly better terms than the DSCR. So yeah.
So you can qualify easier, and you personal guarantee it, but yet your DTI is also affected by your projected rental income.
Well,
is that accurate?
Just remember, you also personally guarantee DSCR loans. So you can finance them in the name of the LLC, but you're still a personal guarantor on those DSCR loans. Like if something goes south, you're not off the hook.
Go ahead, Matt.
What were you saying? No, you're good. Go for it.
I was just going to say, so for somebody that's building up a rental portfolio, what do you think is there a magic formula for the amount of income reserves you should have versus the amount of debt that you're leveraging? Because obviously you don't want to be over leveraged, but you also don't want too much cash. So do you have a specific answer or strategy for this, or what you like to typically see?
Well, so are you talking about cash, or are you talking about debt to income ratio?
I guess basically whatever you have in your investment portfolio that maybe be stocks, bonds, mutual funds versus real estate, right? Because you don't want to have a net worth or just $100,000 in cash and then, $1 million of mortgages, for example, right?
Right.
So I guess do you have a recipe of like how you like to spread that out? Like, does that kind of make sense? What I'm asking?
It does. But I actually have never really thought through that particular exercise. So yeah, I've never thought about in terms of a mix or a portfolio of investments. It sounds like cash investments, stock investments versus real estate investments. I mean, when it comes to lending, there's no magic number there. But from a personal debt risk standpoint, I think that it's probably just a personal tolerance, some people may not have as much faith in the stock side of things as they do real estate, or vice versa. Then you bring in crypto to the mix. That's a whole nother, where does that fit in? Does it fit in? Some people love it. Some people think it's fake money. I think all money is fake money.
Right.
That's true.
So you think it comes down to, so basically the answer is it's the risk tolerance compared to the investor of what they're comfortable with doing and how they can best sleep at night, really, is what it is.
Absolutely. Yeah. I think those that have more experience with real estate, they may feel better about real estate. I think it has to do with understanding, if you don't understand stocks as well, or how to invest in those, you may be more comfortable investing in real estate. So, yeah. Does that answer?
She
Uh-huh.
she could help you do that, Austin. But yeah, so okay, so the 15%, you said the rates are like more favorable than a DSCR.
They are.
What? So if I were to get one like right now, today, like what would the rate be about?
Ooh. Man, now you're going to get me in trouble.
Just guess.
Well, no,
Give me a range.
Rates right now for conventional loans they're in the mid 7s with 1 to 2 points right now.
Okay, so it's a good, okay.
And then DSCRs, I'd say upper 7s, low 8s.
And then the 10% DSCR is about 10, right? That's what I hear.
The 10,
I don't know if that's accurate.
I don't think there's a 10%
Okay.
There might be a 15% DSCR, but by the time you pay the points associated with it, you might as well put 20% down anyway.
That's what I meant.
Yeah. So,
I think, yeah.
It doesn't tend to make sense. Yeah.
So there's also something that you talk about, and I've heard you talk about it a couple of times, and it's you like to help people create a path to become financially free and do the things that they want to do. And you talk about the power of 10 homes. So can you elaborate a little more on that and what you can do to help others hit their goals?
Yeah, absolutely. So part of what I do when I look at financing is I like to ask my clients what their goals are. Are they looking just to kind of dabble, to buy one or two, see how these do? Are they looking to build a portfolio to be able to walk away from their W-2 or at least have the freedom if they wanted to? Sometimes maybe it's just a college fund for their kids. So I think the first step is identifying what the goal is. And then from there, I like to help them build out. So the path of 10 is a game plan I have found from my own experience and a lot of other clients that I've worked with, that 10 seems to be a pretty roundabout number for people to achieve that freedom, that net income amount, for them really to have that freedom that they're looking for. Some will do it in less, some may have the ability to buy a few larger properties and may not need 10. Others have 20, right? But the path of 10, it's a pretty solid goal, I feel like, for most to reach what they're trying to do. Yeah. So the part of the plan there, yeah, go ahead.
No, you go ahead.
Well, I was going to say, so part of that plan is taking a look at assets, debt to income ratio, products that are available for them. I think one of the barriers a lot of people feel is cash. How am I going to buy these properties? Where's this cash going to come from? And so that combined with some, it's not necessarily wrong information out there, but I feel like a lot of people get pressured into feeling like they have to do DSCR loans. And look, we can do DSCR loans. I'll do a DSCR loan all day long, but it's not the only option. There are some lower down payment options a lot of people qualify for. So part of it's also educating them about what's available to them to help them get to their number.
So for our listeners that may be a little bit newer, can you briefly explain what a DSCR loan is and how that kind of, if it has any relationship to your DTI, and what is the DSCR loan how's that structured?
Absolutely. So DSCR stands for debt service coverage ratio. And this is a loan product where your debt to income ratio is not taken into account. So your monthly income versus your monthly debts doesn't matter. So if you or say you're self-employed, you just started a business, then we wouldn't have any income we'd be able to count for a debt to income ratio on a traditional product. So that debt service coverage ratio loan, it looks at the projected rental income of the property you're purchasing compared to that monthly payment. And as long as it's 1.1%, that monthly, as long as that projected monthly income is 1.1% higher, 110% higher than the payment, then you're good, basically. I mean, yeah, so appraise and Your credit score has to be decent. But when it comes to qualifying, the main qualifying factor is centered around the property itself, if it qualifies. You can do those in your personal names, or you can also close those in the name of an LLC. The benefit to the LLC is just that when you close in an LLC, you're still on the hook. You're still personally guaranteeing it, but then it won't count in your debt to income ratio when you purchase other properties, if that makes sense.
So would you just go and you'd have to get basically comparable properties that are producing the amount of revenue, and that's how you go to pitch it to where you either qualify or don't qualify in that kind of scenario?
You can. It's actually more simple than that. Now, here's the thing too. So the DSCR products that are out there, and this is important for people to know, the DSCR products can be completely different. There's not one DSCR product that everybody uses. So the product we use, I don't know if any other lenders have that same particular product or not. Our particular DSCR product, we can use either AirDNA data. We can use a history. If there has been a 12-month history on the property, we can use that. Or we can get the appraiser to do a comparable market report, which they can do short-term rentals, but sometimes appraisers have challenges with that. So if AirDNA works or there's a 12-month history, those are usually the better routes to go.
Gotcha.
So are you going with whatever's higher at that point? Whatever's more favorable to get the loan, right?
Correct. Yep. Absolutely.
Okay.
Yeah.
So they wouldn't even have to bring your pro forma, like good, better, best. They just need to pull the address up on AirDNA, and you guys would be like, okay, 117, great. Coverage is 2.4, cool.
Exactly.
That's it.
Yep.
Wow.
Yeah.
Okay.
Yeah, totally. Yeah. Sometimes people will like spend time building out these elaborate pro formas, and I feel bad, but we don't need it in a lot of cases. But it's good they have that.
That's interesting.
Yeah.
Yeah, it's interesting because AirDNA can be so skewed, and then you look at other things like it all also comes down to like who's managing the property. That could make, a world of difference. But it sounds, simple enough. If an AirDNA, printout or overview of the property is all you need, then, I think people might think that it's too complicated or they're not qualifying. But when you do it like that, it seems like more people might be more interested and qualify for it than you would think.
Absolutely. Yeah. And it's interesting you bring that up. Here's another thing. I really encourage people to try not to figure out loan parameters or loan information on their own, whether it's DSCR or trying to figure out their own debt to income ratio, because there's a lot of like tricks and guidelines and ins and outs. And so I feel like sometimes people do that and they discourage themselves. So I really encourage them to reach out to a short-term rental friendly loan originator so that they can actually, and maybe talk to 2 or 3 if they're not getting the answers that they think they should be. So that, yeah, don't psych yourself out.
Analysis paralysis. That's what that is. It's with anything in life. If you try and figure it out, just find the person that knows it and let them tell you how to do it, right? There's no need to figure everything out.
Definitely. Absolutely.
Well, a lot of people don't know, though, when they're calculating the DTI, that you'll look at their tax return and if they, did a cost seg, you could put that depreciation back and it'll actually show favorable versus a loss. Things like that you will do that other people won't do or know that they could do. So I do have kind of a question with the DSCR, or let's just say any kind of debt service coverage loan. I don't know if there's I think you said there was a debt service coverage on the other conventional one, or you have to show some kind of, right?
Well, the other one's a hybrid. So that one, your debt to income ratio still matters, but we can use projected rental income as well. So let's say you have a 43% debt to income ratio before you purchase another property, right? And so purchasing that property would put you at like 60 DTI, which is too high for a conventional loan. But the projected rental income on that property is enough to offset its own payment at a minimum. Then theoretically, you'd still be at 43% debt to income ratio by the end of the transaction. So that's how you can do the investment occupancy conventional, where debt to income ratio still matters and still qualify. So the only times that really wouldn't work is if your debt to income ratio is already at like 60 or 70 or something. That may not be your best route.
What if it's at 60 or 70, but with another house that already pays for itself? You could take that money and calculate that in, right? And then recalculate it. Like if I calculated it myself per se, it's 70 because I'm not like, let me take all the money I earned from here, the money I earned from there, and put it in there. So what if somebody had, what would be I mean, I don't know if there would be a good option or not, but if somebody had 3 or 4 rentals and they had equity in those, but they didn't want to sell those or cash out refi or HELOC, but they wanted to qualify for another mortgage, but they weren't liquid, is there something that you guys could do on that?
In terms of using the equity from without a HELOC or no, not for us. There may be if they find the right portfolio or a bank, sorry, not portfolio, like a depository bank, a local credit union. Sometimes they're able to use those properties as collateral. The challenge there, though, is that they'll usually put some kind of lien against them towards it may not exactly be a HELOC, but if they're incorporating them into a loan for the new one you're purchasing, they'll typically have some kind of security instrument. But yes, they may be able to do that without technically doing a cash out refi or HELOC.
So I guess, can you talk about the best way maybe, or what you've seen for traditionally, like in structuring partnerships? Like, let's say I'm the person that I find the deal, I'm going to be the one managing the business and stuff like that, but I want to leverage my knowledge, my experience with somebody else. Like I have friends that are high income earners. They make $400,000, $500,000 a year. They want to buy an STR. So I'm the guy, I'm going to find the STR for them. Is it possible that I could structure the deal, or how have you seen this done in the past, where they bring the money to close? Maybe I work something out where I manage 2 years for free or whatever the numbers say, and then I can potentially become a partner. Is that something that I could leverage in the future?
Yeah, so I'm not always privy to exactly the details of how people set it up, but what I can say that I see done on tax returns anyway is, the person qualifying will purchase the property. They may partner with somebody like yourself to manage it. And so then it'll show up on like a partnership return on a 1065. And so I have seen it that way. And then the split, they can you can figure out the split, right? Maybe they're 60, 70% owner because they brought the money and you're 30 or however it is you want to work it out on the back end. So,
the cost if they were to do a cost segregation or something like that, and there was a ton of money that would go back, they funded it. I mean, that would be their money. Like they would be the money because they came to me to offset their W-2 income. The cost segregation money goes to them, and then that would be fair, and we would establish some sort of partnership from there, maybe.
Yeah, if you cost seg the property itself, I know on the partnership return. Now, this may be a better question for a CPA. Typically, Typically what I'll see though is it has more to do with the percent of ownership of the partnership. And so that cost seg, so there's a form in there called an 8825, and it's essentially the business schedule E. It's like the business rental schedule E. It's called the 8825. And so that's where that depreciation would go. And then it's just divided so each person gets their portion, like we were talking that 70-30 split of that. Because it really, at that point, the cost seg's going against the entire business income versus just to one person. Now, there may be a way for a CPA to designate that to one person, but that's over my head.
Sure. That makes sense.
Yeah, I think with that, Austin, it would go in the percentage of the partnership. But if you have high income earners that are looking for a partner, send them my way. No.
Yeah.
So
yeah, I actually do. Go ahead. Yeah, but go ahead.
Okay. I got a performer for him. We can go look at a house.
Nice.
Yeah. Now I forgot what I was going to ask. So there was that. Thanks, Austin. No. So you don't suggest everybody should just go run and do DSCRs. There's other ways that you can help them obtain a mortgage. Do a lot of people come to you trying to get second home loans and they're like nowhere near qualifying for second home loans?
Sometimes, yeah. I mean, I would say usually what happens is in a lot of cases, it's not that they're nowhere near, but they may qualify for less with that 10% down since we cannot use projected rental income. So, that's where I'll say, well, hey, you can go up to this amount as a 10% second home. But then if you wanted to go over it, you can go up to this amount with 15% down. So it's only a 5% difference in terms of the down payment on those two. So yeah, that does happen.
And then if you were to purchase, go ahead.
Mhm.
Good, go for it.
So I was gonna pivot a little bit. So since I'll talk a lot about co-hosting, but you just strictly manage your own properties, right?
I do.
So let's say I'm an owner. Okay, so let's say I'm an owner. I've got a property next door to one of your properties. It's going to gross with your management $250K, and I want you to manage it. Would you entertain the idea of ever managing for someone else, or you're like, hey, I'm just own my own properties. I do my mortgage business, and that's it. But what if like the golden goose just landed in your lap? You interested or not?
I would have to ask my husband because I would probably put that on his plate. Good old
Okay,
odds,
gotcha.
right, Matt?
Makes sense.
Yeah. Talk to Oz if you want to know.
Yeah.
If you want him to do it, bring him something to drink. Be a nice guy.
He would probably say, oh, heck no. I have to deal with my wife and our properties already.
Yeah. He'd be like, she already has me fixing something.
Yeah. Yeah. I hesitate. I'd never say no, right? I don't have very many absolutes. So I'd have to say maybe, but we've got a pretty full plate.
She'd have to go home and do some schmoozing first to get him to say yes.
Yeah.
But what I was gonna ask was so like if, for instance, if I were to go contract on a house, and let's say I don't know with your DSCR product, if the seller were to give me cash at close, what percentage could I get with that DSCR?
6% on the DSCR.
6%. Mm-hmm. Okay, so let's just say I got 6% cash at close on let's just say $500,000 house. Would I be able to use that money toward the down payment, or would I have to show the down payment prior?
Well, okay, so here's the deal with the 6%. It can never go towards down payment. So it's actually a max of 6% of the sales price or the actual closing cost prepaids and points. You may not have, in fact, you probably won't have, you may not have 6% in your closing cost prepaids and points. And if you can't use it all there, then typically what people need to do before closing is lower the sales price to eat up the extra, or you could buy down the rate. I will say be cautious. There are some brokers and maybe some lenders out there that will use that 6% to kind of cover up the fact that they have higher origination fees and points on their rates. So I just caution everybody to be careful when a lender is pitching you, well, hey, you can get 6%, forget these fees, forget this, do your homework still on what their points and fees are. 6% is great though, if you can get that, because it keeps money in your pocket. Just make sure you're not just falling for that line and not doing your research on rates and points out there. If that makes sense.
That's crazy.
Yeah.
That's crazy. They're promoting that like they're the realtor and they're going to get that for you, or?
Well, no, but they're like trying to hide the fact that their fees and rates might be a little bit less competitive than others. But it's kind of like, well, hey, don't worry about the fact that you're paying this much in fees because you're just going to ask for it from the seller when there could be lower points and fees out there. So in other words, if you have a lender that's really pitching that hard, there might be a reason. Like I never start with, well, hey, you can get 6%. I start with, hey, here's what the rate is. Here's what the points are. Here's what this looks like. You may be able to get up to 6% from the seller. See if you can nail that. But I'm not like hardcore pitching, hey, you've got 6% to use, if that makes sense.
That's like a don't pay your deductible body shop. Oh, we'll pay your deductible for you.
Yeah, totally. Here's another thing too, on that note is, I've been trying to think of a better way to say this, but be cautious of lazy lenders. And maybe they're not lazy, maybe they just don't understand, but the ones that go straight for DSCR and don't even look at your other options. DSCRs are easy. I mean, it would be easy for me all day long to tell somebody, yep, you qualify for a DSCR, right? But I like to educate my clients, at least the ones that want to be educated. It's like, well, hey, let's just look at your overall situation. Let me tell you what you could do from a conventional standpoint. You don't have to go conventional, but the knowledge is good. So let's take a look at your overall situation. So, you could do, second home or investment, or maybe you do need to do DSCR. So, or a lot of times if somebody offers a DSCR, hey, that's easy, path of least resistance, and that's all they offer. So ask questions.
Yeah. That thought process better that you go about your business of trying to help people first and find what's the best situation for them versus trying to say, hey, if I sell this product, I get this. It's more of like, hey, what's best for you? And that reminds me of something like I met with a potential client last weekend and we were running the numbers and it would have been a great property to manage. But after she told me all the back end financials, I was like, honestly, if I were you, I would just long-term rent this. And then if you want to do short-term, I'm here to help you. I'd love to have your business, but you're better off basically looking at these numbers to make it a long-term rental. And they appreciated that so much. So I like how you do that. But the one question I was going to have, so like with these specialized typed loans, like the DSCR loan, is there like penalties if you were to sell it earlier? Is there like a certain time period where you have to be within this loan before you're not penalized? Kind of, does that make sense?
Yeah, there are on some. There are, in fact, a lot of DSCR products have prepayment penalties. Our in-house DSCR products do not have prepay penalties. But yeah, that's another thing to be cautious of. And sometimes people forget when they're thinking, oh, prepay penalty, well, I'm not going to refinance this for 3 to 5 years anyway. That's fine. But they forget that comes into effect if they sell it as well. So what if something happens and you need to sell it, or you have a really great, there's another property that's come up that you want to buy, but you have to sell this one to buy that one. I think a lot of times people forget that prepay isn't just about refinancing. It's also about selling the property.
Gotcha.
No, make sure they get their interest for loaning you that money. So the ones that have a no prepayment penalty, is it a higher interest rate normally?
I think ours are pretty competitive. I mean, we're in the upper 7s, low 8s with 1 to 2 points, depending on the situation. That's 20% down. So I don't think so. We don't have a prepay option on our in-house, so I couldn't really tell you what it would lower it to. But we do have a brokered product as well, and that one does offer some prepay. But I really haven't had to use it because our in-house product is so strong. So
nice. Yeah, I would say that everybody needs to research their lenders and go to several different lenders. I know that when I first got my vacation rental, well, it was just my vacation home, that I went to get a second home loan, and they're like, oh, yeah, all good. Qualify. Here's your letter, blah, blah, blah. And then next thing you know, he's like, no, Freddie and Franny want 20% more. They want 10 more %. And I was like, okay. And I paid points, and it cost me a lot. Like, I mean, I put more than, by the time I was done, it was well over 25% of what I put down. But
wow.
It was, but that was me. That was my mistake. I didn't go with anybody else. I went with the lender that got me my primary residence. I didn't know any better, and let that be a lesson to everybody else out there, I guess. Yeah. So gotta vet what you're doing there.
Oh, yeah.
So I've seen you be on a lot of podcasts and out there lately, giving some speeches and stuff. So what's next for you? What is your plan? Is your plan to take, Wealth Builder Mortgage and just build it? Or is your plan to do other things, start a podcast, or whatnot?
Yeah, good question. So Wealth Builders Mortgage Group, we are a team within Movement Mortgage. Movement is a national lender. And so my goal is to grow our team a little bit. I don't need to get huge, but to grow our team a little bit. I've got a couple great loan officers right now who specialize as well. And that's the thing. Like, I want this to be a very special group where clients can trust we know what we're doing. when it comes to helping them build their portfolio. I'd like to do a little more coaching in terms of my own knowledge and experience with our own rentals to help others feel good about what they're doing as well. I don't have plans for like any kind of paid coaching or programs or anything at this point there. Just getting some knowledge out there, some firsthand knowledge. I do plan on starting a podcast soon. I think there's a need for great mortgage information and for people to understand, because there's so many people that give mortgage advice. I see it all the time on Facebook, and I just want to, face palm every time, right? I'm like, why are you saying that? So hopefully something out there that could really help educate and get people excited and get people to love mortgages, because mortgages are a great vessel. So I'm working on building some education. I'd love to help people really understand their options and how to get to where we are. I don't have to do mortgages. We're at a point now with our rentals. I could walk away, and to me, that's having that choice. It's freedom. But I love what I do, and I love helping others, and I love seeing them achieve and start to achieve what we've been able to. So, I don't know if that answers the question.
No. I mean, I know you personally, so we're in the same circle. So it's like, I can see that you're passionate about helping people build wealth and get mortgages, but you're also passionate about short-term rentals. So it's like you're split between the two. So I don't know how you balance these two things, but I think you have a lot to share, especially to be able to help other people. So that's fantastic. I think that's great. So when are we starting this podcast for accountability issues?
6 weeks.
Oh, okay. So let me hold on.
Yeah.
I don't ever write anything down. You know me, so I'm gonna write this.
Yeah,
down
right.
here
I like it.
so I don't forget. And I have a personal question. Are you going to the next meeting? Because if you are, I will bring you a hat.
Oh yeah.
So if you are going,
yeah,
okay,
definitely.
so
I plan on it. Yeah.
I will bring you a hat. Then I do have a hat. I'll bring you.
Absolutely.
Rather than mail it to you, I'll save a couple bucks.
Nice. I like it.
I still have to work my job, So yeah. So we're gonna have to get together on. I'm not really sure on what kind of loan product I'm gonna look at. What I'm gonna do. I'm trying to get my other house sold. We may have discussed that a month ago or so, but when I do, I'll be making a phone call.
Yeah, and to that point, here's something else, because this may help you guys too. I think a lot of people feel like they need to know what their plan is or have a house in mind before they get pre-approved or go through that pre-approval process, right? And that's so backwards. I understand why people think that, but it's so backwards. I think in order to figure out your game plan, you've got to have the tools to know what you're working with first. And so I really want to let everybody know, hey, if you're just thinking about maybe getting into short-term rentals, go through that pre-approval process. The pre-approval process isn't for any property. That's just to understand where you are, what your debt to income ratio is, what it's going to take, right? So definitely be ready to do all that in the beginning, whenever you're even thinking, what do I want to do? What can I do? Yeah. So that goes for you, Matt, whenever you're ready, just to kind of know in your head, what can I do? Same thing.
I could do anything. No.
Well,
yeah, we'll see. But so I wanted to ask another question about the DSCR, because my question I just finally remembered. So when you get a DSCR loan, you have to have a certain amount of reserves, right, left for you to be able to get that loan. Like either I don't know. I've heard people like half of it could be a 401k, the other half is liquid. I don't know if that's true or if that or your product does that or not. Can you explain a little more on that?
Yeah. So after cash to close is accounted for, our particular product, you need 6 months reserves. And so, some of that can be in a 401k. It could be in stocks, bonds, no problem. Basically, it just has to be money that's accessible to you if something were to happen, right? So like if you have a 401k with 200,000 in it, typically only 50,000 is really going to be accessible until you terminate your employment. That's a government thing. You can borrow up to 50% or 50,000. So we could count 50,000 of your 401k there. And then if you had some in stocks, bonds, whatever, we can count all of that. And then, of course, savings. And so, yeah, the 6 months reserves of the new payment is what ours requires.
Okay. That sounds interesting.
Yeah.
So I know it's kind of specific, so you don't want to give specific financial advice, but I guess I have a question about people that do have a lot of money in a 401k. Can you leverage that money to buy real estate? Is it often makes sense where you can borrow that money to where while paying it back, it makes sense to buy real estate with it?
Oh yeah, I love borrowing. I love the borrowing from the 401k because you're paying yourself back with interest. You're not paying anybody else back. And it's usually pretty easy. Most plans will allow you, but that's something determined by your company. So you definitely need to check with your HR. But most of the time you can borrow up to 50,000 or whichever's less, 50,000 or 50% of your 401k. But yeah, I think it's a fantastic option.
What about an IRA? Is that different from a borrowing perspective? You can't borrow from that, right?
Correct. That one you'd have to withdraw from. That one we can actually, so when it comes to reserves, we can use 100% of an IRA because you're able to withdraw that, all of it if you wanted to. There are some tax penalties. I don't know exactly what those are on the IRAs. And I think there's also, and this is something for those of you who have IRAs that want to look into it, I believe there is something where you can take it out for a certain amount of time. And if you pay it back within that time frame, you don't get taxed. Don't hold me to that, but something you may, for those that have IRAs, they may want to ask a CPA.
Interesting.
Yeah.
Or convert it to a self-directed IRA.
Oh, don't do that.
No, don't do that. No, I don't know. Don't ask me. It's what I heard.
Yeah. You could.
I'm just putting that shit out there. I wouldn't.
Self-directed IRAs are okay, but they get really messy when it comes to buying real estate because you can't really get traditional financing. A lot of them require it to be a non-recourse loan. And then it's just a little messy, like somebody else has to manage. You can't be hands-on. So it's tricky with the self-directed IRAs, at least when it comes to real estate investing.
So don't do that, everybody. It's a pain in the ass.
There you go. Yeah.
I forgot my other question because you said you were going to go, Austin. But so with the 15%, does the same thing apply with having the amount needed 6 months or whatnot, the buffer?
Yes. So Fannie Freddie requires 6 months of the subject property, plus they'll require, depending on how many other properties you own, they'll require 2 to 4% of the unpaid balances of your other properties, except for your primary.
So they want, if it's on the same type of loan, if it's on a second home loan, does that still apply? Or
any other properties you own except for your primary? So if you have 4 other properties with mortgages on them, the total balance, that would be, I think if you had 4 others, that would be 6%. So then we need the 6 months reserves for the new property plus 6% of the unpaid balances of those other 4.
that's good to know.
Yeah.
So you're putting 15% down, but you better show some money somewhere else.
Right.
You're going to have to.
Yeah. Most of the time people are covering that with retirement accounts, the reserves.
Yeah.
Yeah.
That makes
So
sense.
does combining on a loan with your spouse, if you can do it combined or you can do it separately? My understanding was if you can do it separately, always do it separately so you can you won't eliminate yourself later on down the road with your debt to income ratio. Do you recommend doing that? If we have loans in one person's name that they can qualify over here, next one, boom, over here. What are your thoughts on that?
100% every time. Yeah. If you don't need both to qualify, always try to put it under just one.
Okay, good deal. So we did that, and I think that was the right decision, but I just wanted to hear what your thoughts were on that.
And on primary homes too.
That's what you did it on, right, Austin? Your new house?
Yes. So this one we just bought was in her name. And we were able to, since it was just in her name, we were, get a lot lower down payment because it didn't count now because I have two houses. And then I guess if we were on it together, they would count my two houses. And then I'd probably have to put like 20% down because I couldn't use a first time home buyer loan, but she was able to use the first time home buyer loan herself, and hopefully we did that legally. But everything went through the approval process. We bought that process. I mean, we bought a new build, so I don't know. So I got my two leveraged with low money down, got hers, and the other two are rentals. So that's what we did. So I think it worked out.
Awesome. Good. Yeah. And even without being a first time home buyer, you should be able to do on a primary 5% down on a conventional loan.
Oh.
Yeah. Yeah.
I think so. I don't know if we did the FHA or 5% conventional, but I got you. That makes sense.
Totally. Awesome.
That's what I did on my primary, 5%, because I didn't want to give them all my money. And Austin did it legally, everybody, just so you know. It wasn't illegal. It was by the book. He dotted his I's, crossed his T's, all that good stuff. Right,
yeah,
Austin?
so don't go sniffing. Don't go sniffing around. I don't got nothing.
Nothing to see here.
Yeah, nothing to
Last
see here.
time we did something like this, we were talking on the last episode, and we were all talking a little trash about Verbo. And the next thing you know, everybody's phone's blowing up with like Verbo inquiries and bookings, and we're like, "What the hell's going on?" Like they know what's going on. It was so weird.
That's
It's
funny.
like they were listening to us. So maybe the mortgage guys are listening to us, going to hook us up with a low rate.
Yeah.
Low down, low everything, low.
That's funny.
Just a good appraisal.
Great. Yes. Yes.
So
okay, let's talk some more trash about Verbo so I can get some more bookings.
Yeah, I know. It's funny because we were talking about it, and we were sitting there, and Austin's like, "Oh, look, I got one." He held his phone up. He had a booking, and then it was like, "What the hell?" And then like right when we're about to get off, he's like, "Wait a minute, I got another one." And then like an hour later, I texted him. I said, "I just got an inquiry from Verbo."
Nice.
It was so weird. Like I never get anything from Verbo, but hey, Verbo, hit me up.
There you go. Verbo's so weird. It's hit and miss. Yeah.
Yeah, I think it just depends on your location, really. Like it's some places it's like strictly like old heads, just like this is what they use. Like it's the shittiest app in the world, but it's what they use. It's not easy to use, and yeah, it's crazy. Like some places it's like total Verbo, but everywhere else it's like Airbnb. So it's weird. It's a trip.
Yeah.
Yeah. So are you guys booking direct with your stuff through OwnerRez? Is that what you're working on right now?
Yeah, we've gotten a couple. So yeah, we did. It was nice to be able to just hit a few buttons and have that, the little direct booking website pop up. So that was definitely a plus. And we've gotten, I think, 3 or 4 since we've done it that way. So it's good.
It's good. That's exciting.
I don't love processing payments.
Yeah.
I really don't.
I wouldn't either.
That's why Hospitable, I'm like, maybe. Well,
are you using Stripe?
Ascent.
Okay. Mm-hmm. Yeah. The cool thing about Hospitable too is I'll tell people, like, if you pay for their premium direct, like when they process the payment, like they're the merchant of record. Mm-hmm. If you don't pay for direct, they don't process. But if you pay for direct, though, they're the merchant of record. And if there's chargebacks, they'll eat the chargeback.
Yeah.
It doesn't even cost you anything, nothing.
Yeah.
So it's and they charge your guest, I think, 6% plus $10, which is still lower than both OTAs combined. It costs you like $5 a month per listing. So
okay.
I mean, maybe check it out, but
yeah,
it's not a pitch for Hospitable. I'm not getting paid, but I do have one of your bottle openers, so thank you for that.
Nice.
So, do you think you'll ever reach a point in your STR journey to where you'll offload your properties to a manager, to where you're like, okay, we can just have somebody else do that now, or do you're just like, I like the way I run my business and I'm going to continue to self-manage? Or at any point you think you might hire a co-host or something like that?
Yeah. If you had asked me that a couple of years ago, I would have said, no way. For a long time, I was very, well, and I still am to some degree against property management from a big company property, like a Vacasa. I'm in the Smokies, and the Smokies have had rentals for decades, but it was always property management companies before Airbnb and Verbo, right? And those property management companies, they charged a lot. They did a crappy job. People didn't make money. And so at first, that was the whole thing, like manage yourself. But now I feel like with the, like what you guys are doing, and then with the co-hosting where it's owners that, others that own properties that are also doing this personalized co-hosting management, I do like that. And I think that now, especially, so when we bought our first back in 2018, it was set it and forget it. It was hard to go wrong, hard to mess up. You throw it on Airbnb, you're going to book, make $1 gazillion and call it good. Well, now, there's the algorithms, there's the pricing, there's the making sure your pictures look great. There's a lot more competition. And so I do feel that the right co-host, or I don't even like to call them property managers, even if that's what they may be, just because when I think property manager, I think the big companies, but the co-hosting, I think there's a lot of people that have that knowledge that may be able to focus on that and do a better job than what I do. So, I have thought about it, and I feel like once we really get our process completely down, that could be something in the future that I'm willing to let go of.
Yeah, I think it also depends on where's your time better spent. Like if it is taking up much of your time, then you want to you can allocate more time to your mortgage business, then maybe that's the thing. Plus you're all in one market, so you could potentially leverage a lower percentage. If you find the right operator, you could do 15% of the nightly rate, where 20-25 might be normal for somebody that's really good, but they're like, hey, you get potentially 7 properties out of it. So I don't know, I was just curious. I like to talk the management side of things and see kind of where you're at and what your kind of what your long-term goals are. So that's cool. Thanks for sharing.
Yeah, absolutely. And I definitely encourage people more now who are nervous about taking it on themselves, or, to your point, don't have time, or they have a better use of time. I do encourage them to talk to co-hosts now, and before I never would have, but the last year or two, I've seen that emerge, and I've been impressed. I think a lot of people are doing a great job out there. So
It's tough.
mm-hmm.
It's not, you can't just leave it be. So for everybody out there, though, before they start contacting you for mortgages, let's tell them where you can do this at. What states are you licensed in, and offer those products to?
Great question. I am licensed in 39 states, so most of them. Yeah. So there's a very good chance it would take me a while to list those all out, but 39.
Okay.
If you go to our website, which is wealthbuildersmortgage.com, there's a map on there as well that shows the states that we are licensed
in. We'll put that in the show notes.
Awesome.
I thought it was less than that, so I didn't mean by name off all 39. Yeah, but if you can, Alabama, Alaska, Arizona, Arkansas.
Right, yeah.
So can you tell everybody where they can find you, how they can get a hold of you, social media, whatever the case may be? Because you're not just Wealth Builders Mortgage, right? You're Parker, and you want to help people. So where can they contact you so you can help them?
Absolutely. So if you go to our website, wealthbuildersmortgage.com, there is a link to, you can submit an inquiry, or there's a link to Mike Callenly and also Rob Breckenridge, who's our senior mortgage loan originator. He's amazing as well. He knows all these tricks. So you can schedule a call with either of us, submit an inquiry there. You can also find me on Facebook, just Parker Borofsky. I'm out there, so feel free to message me. I'm still learning Instagram. I'm a little behind the curve.
Your content looks good, by the way. I checked it out a little while ago, and it looks professional. I like the Instagram deal you're doing. You're doing a good job.
Thank you. Good job, media team. So so learning there. But yeah, I'm on Facebook a lot. I'm a Facebooker for sure. So yeah, so feel free to reach out, contact info. Yeah.
I don't know what it is with Instagram. I don't know. It was tough. Like, it was like MySpace was cool, and then Facebook came along. It's like I learned that, and now it's Instagram. I'm like, I don't know, dude. Like, can I just link these together so when I post something, it goes to both? My wife's like, I sent you stuff on Instagram. I'm like, I haven't even looked. I don't know. Like, I'll look later. I don't even think about it. Honestly, it's like not the same.
Yeah. Mm-mm.
Maybe it's too hip for me, I guess.
And Snapchat's like, oh, I don't even know what that is. I know you snap them
shit.
and then it disappears, or I don't know. Yeah.
Yeah, that's sketchy. Like, let me send you this, and then it's gonna disappear. It never happened.
No.
So they can gaslight you on the internet, I guess.
Right. Yeah.
That's crazy.
Yeah.
Well, we really appreciate you coming on. I mean, I want to be cognizant of your time. I know you got things you have to do, loans to write, and we really appreciate it. And we look forward to your podcast, which, by the way, everybody's coming out on June 30th, which is 6.5 weeks from now.
Thanks, Matt. Thank you.
And I'm going to bring you a hat, so I won't forget that. But yeah, so really appreciate it.
Hey, I have a question for you guys.
Yeah.
So what are you doing with Co-Host Bros?
We're just here for the people.
Okay.
Whatever they need, you know?
Yeah.
I mean, it's tough this month because we just been recording like back to back. We got 2 this week, 2 next week. But then I slacked a lot last month because we were in Gulf Shores, and then I was in Montana, and then we just been gone. Our calendars didn't work. So I just play secretary now, and I set up calendar invites, and then Austin is forced to come.
Nice. I like
Right, Austin?
Yeah, exactly. Yeah, I think we've kind of found a gap where a lot of people are talking about short-term rental stuff, this, that, and the other, but nothing really comes down, I think, to specifically co-hosting. So we like to have other people on like you that can share all sides of short-term rentals, but kind of trying to gear the focus towards building co-hosting brands because, like you said, over the past 3 years, it's become so popular and so many people can. You know, the barrier to entry is low. That doesn't mean you're going to stay around and do well, but a lot of people are interested in this. So that's where we're kind of trying to fill that gap of like, hey, we talk about how to build a co-host brand. And then we just have, you know, we've had some really great guests, you included, but that's what I'm thinking.
Okay, great. Have you guys talked to Patrick Switek yet?
Oh, he was our second episode.
Oh, good. Okay, good.
Yeah.
I like him.
0 to 100 with Patrick.
I love it.
Smart fella.
Yeah.
Smart fella.
He's so young too. He's smoking it.
Yeah.
Oh my God. He's just like, oh, so I bought one. I'm like, bought what? Oh, a whole company. I'm like, what? Okay.
Yeah.
Oh, shit. Oh, cool, dude. I would just be happy if I could buy a Chevron. Like, my God.
That'd be great. Yes.
It's no big deal. He's like, I just bought my 3rd one. I'm like, this guy is a savage. His goal is to actually hit 10 million. That's his goal, is what he told us. So he wants to hit 10 million. Very impressive guy.
Yeah.
Really.
Yeah.
Yeah, we've met some crazy people. So, but it's good. It's good to meet people and get to talk to people. I mean, people we know, people we don't know. So I think it's good for everybody. And yeah, we really enjoy having people to come bullshit with us, I guess.
Yeah.
Take our personalities.
No, you guys have great personality. I was excited for this. Yeah.
Good.
You guys are great.
Everybody keeps saying that, yet our views don't show it, Austin. What's going on?
Not yet. The snowball effect is just building. It's going to take off. It's building. Yeah. Just wait.
The last one that was on, she was like, "Oh no, I listened to your stuff," and I'm like, "You don't have to lie, you know, because we're on the internet." And then I was like, "Oh, you subscribed to our YouTube 15 minutes ago. Good job." Like, I get notification, lady.
That's funny.
Okay. No worries.
Yeah, but I think one learning process of this was like, it's not that hard to get great guests like yourself, because we kind of built the platform and everybody wins because we get to interview you and then you get to share a lot more about your business. So I think like since we've built the platform, it's kind of just organically attract a lot of the people that we wanted to be talking to in the first place.
Definitely. And it's good to have a platform to share some of this. You know, I think part of my personal passion is just I see so much bad information out there that I like want to scream and tell people, no, that's not the only way, you know. So it's great to be able to have a platform like what you guys have built to share some of that. So I definitely appreciate it. And you guys are fun. It's kind of fun to do this too. So
we like to have fun. So,
yeah.
So your podcast is called Wealth Builders Set It Straight.
Oh,
I'm
yeah.
Just kidding.
I think it should. I like that. Maybe I'll change it. Right now it's Path of 10, but I like that Wealth Builder Set It Straight.
Or Set It Straight. Set It Straight works too. I mean, I don't even have to check and see if anybody has that. But if they don't, man, it's a hell of a name. I mean, you'll be all right.
I like that.
Yeah. I'll take 5% of royalties.
Hey,
Don't worry about it. I'm just kidding.
they'll send it to you.
All right. Well, I really appreciate you coming, Parker. So thank you so much. And we're sorry if we were not as lively as you want us to
No,
be.
you guys are great. Thank you so much for having me.
We have to wait a second for Austin to say peace. It's going to take him like 10 minutes.
Yeah. Peace.
The Co-Host Bros Podcast.